Good afternoon. Thank you for joining Mayor Brown's Reverse Inquiries Workshop Series. Today's session is entitled Recap of Bank Regulatory Developments. My name is Matt Bisanz, and I'm a lawyer in Mayor Brown's Financial Services, Regulatory and Enforcement Group, and also participate in the cybersecurity and data privacy practice in our Washington, D.C. office. Joining me today is Jeffrey Taft, who is a partner in Mayor Brown's Financial Services Regulatory Enforcement Group and also participates in the cybersecurity and data privacy practice. He regularly represents U.S. and foreign banks on regulatory and compliance matters and advises on issues related to deal structures, permissible activities, and bank insolvency. Some housekeeping items before we begin today. Please feel free to send us questions through the meeting's Q&A section. If we do not answer them in the middle of the webcast, we will address them at the end of the session and if there is time after. For those seeking CLE credit today, you should have received an email with links to the affirmation form and an evaluation form with the webinar's connection details. We will announce the CLE code once during the presentation and once at the end. Please return all completed forms for CLE credit to the Mayor Brown email address listed at the bottom of the documents. Additionally, we would like to note that we will be circulating a copy of today's presentation materials in an email in the coming days. Thank you, and with that, we will go ahead and get started. Melissa, could you page? So we will be, can you go back one slide, sorry. So today we will be covering 4 items on our agenda. The first topic is I'll be discussing the 2020 amendments to the covered fund provisions of the Volcker Rule and how those are being implemented. Then Jeff will talk about the implementation of the Federal Reserve's Rule for Determining Control, which also was substantially changed early in 2020 and has been implemented over the past few months. I will then turn to finalization of the net stable funding ratio requirement, including how it will be implemented later this year and some of the issues that are developing with how it interacts with the LCR requirement, brokered deposits, and other regulatory requirements. And finally, Jeff will take us home with some comments on the additional tailoring of enhanced prudential standards under the Dodd-Frank Act. Slide. Next slide. The Volcker Rule for many on this call is probably, it seems as if it's been with us a lifetime, but it's only been with us for 11 short years. It was implemented as part of the Dodd-Frank Act in 2010, and it's technically in Section 619, but it's commonly referred to as the Volcker Rule because it is attributed to Paul Volcker, the former chairman of the Federal Reserve. It was intended to restrict banking entities from engaging in 2 categories of activity. As most notable for those who are familiar with the structure of the Volcker Rule is proprietary trading, which while that is a significant half of the Volcker Rule, it was significantly amended in 2019 and therefore is out of scope for today's presentation on recent developments. The other half of the Volcker Rule, commonly known as the covered fund provision, restricts banking entities from sponsoring, investing in, or having certain other relationships with covered funds, which we'll get to that definition and go over it in a few minutes. But that is the part that was overhauled with last year's amendments and is going to be the core topic of our discussion today. Under the original Volcker Rule, which was finalized in late 2013 and then implemented through 2015, the approach originally was guilty until proven innocent. Terms were defined very broadly. Banking entities need to identify and demonstrate compliance with an exclusion or exemption to be able to engage in an activity. That approach was cut back in part by some of the 2019 revisions, which assumed innocence for most banking entities, particularly with respect to banking entities that had limited prop trading activities. It would assume innocence for them, even if they had substantial covered fund activities. That was one of the real, I'll say gems in the 2019 revisions was to look at a banking entity's prop trading activities and use that to establish the compliance category for the other half for the covered fund activities. Under both the historical approach and even under the current approach, the Volcker Rule has a broad extraterritorial impact on banking entities' activities outside of the United States. And again, we'll recap what that means in a minute. And also it has some issues that are still unaddressed even with this most recent round of revisions. Slide. But initially, after the 2014 finalization of the regulators were resistant to making changes. There was one change to address certain types of CDO obligations. And there were about 20 or so FAQs that were issued by agency staff over the years to smooth over rough spots. Some of them you'll be familiar with for things like marketing activities under some of the outside the US exemptions. But really they were just smoothing things over. What was a real impetus for change was in 2018, Congress amended the statutory part of the Volcker Rule to exclude most smaller banking entities from the scope of it. Buoyed by that reform effort in 2019, 2020, the regulators implemented Congress's action and made other revisions to it. And that's what the topic of today's discussion will be. Slide. So the first part is something that is unchanged. The covered fund half of the Volcker Rule prohibits three types of activities, which again, I'm sure many on this call are familiar with. First is a banking entity may not sponsor a covered fund. Sponsorship is further defined as a very narrow scope of activities related to investment management, some trustee activities, and so forth. The second prohibited activity is acquiring or retaining an ownership interest in a covered fund, which you may hear me slip and refer to as investing in a covered fund, although it is much broader than what we would traditionally think of as an investment interest. That ownership interest is an expansively defined term. And the third prohibited activity is serving as an investment advisor, again, in any of these listed functions on the slide, to a covered fund and engaging in a covered transaction with that fund. For these purposes, covered transaction is defined by reference to the Federal Reserve's Regulation W, or Section 23A and B of the Federal Reserve Act. And we therefore refer to it as Super 23A because it applies the restrictions from Reg W, which govern an insured depository institution's transactions with an affiliate. It supersizes those restrictions by applying them to any of a banking entity's relationships, or any of a banking entity's covered transaction relationships with a covered fund. These were not changed. These prohibitions at their core were not changed in the 2020 amendments, and instead, many of the changes were made to the exclusions, exemptions, and other compliance rules. Slide. Typically, when we look at a covered fund, we have a few steps of analyses to the covered fund prohibition. And the first, as we said, the definition of a covered fund, that's is it a vehicle that relies exclusively on Section 3, the exemption in the Investment Company Act in Section 3C1 or 3C7, or is it a certain type of commodity pool with a commodity pool operator arrangement under the Commodity Exchange Act? Or for U.S. banking entities, is it a foreign equivalent fund? That definition was not changed by the 2020 amendments. Rather, what was changed were the exclusions from that definition, which again, as practitioners are probably familiar, there were a dozen or so exclusions built into the Volcker Rule, and some of these exclusions were expanded and others were added. The next step that we do in our analyses is if an entity if a covered fund is still within scope and there's no exclusion, is the covered fund itself if a covered fund is not a covered fund because of an exclusion or for some other criteria, is the entity a banking entity by virtue of being controlled by the banking entity? And so this is for something Jeff will touch on later in his presentation on the control rule, that a banking entity may control a vehicle under the Fed's control rules, and a controlled controlled entity is a subsidiary, as many from the Bank Holding Company Act are familiar with. A subsidiary of a banking entity will itself be subject to the Volcker Rule. And so it's conceivable and often encountered that you may have an issuer that qualifies for an exclusion from the definition of a covered fund, say the loan securitization exclusion. Maybe it's a 3C, 5C fund, something like that. But it is majority owned by a banking entity, or a banking entity is the manager of it and has a management agreement with the issuer. And thereby the issuer themselves becomes a banking entity subject to the Volcker Rule. And that can complicate things for multi-tier structures where you might have an excluded covered fund investing in a non-excluded or an exempt covered fund. And so that's a tricky part, that there were some new exemptions added to that provision. The next part of the analysis is if a entity is a covered fund, is the banking entity sponsoring, acquiring, or retaining an ownership interest in the covered fund? And for many, this is what we think about as the core of the analysis. And the good part from the 2020 revisions is that the definition of ownership interest was narrowed in two key respects that we'll talk about. If there is a sponsorship or ownership interest, the next part of the analysis is the activity exempt. And one topic that I'll mention now that we really won't be talking a lot about in detail is the SOTUS exemption. The reason why SOTUS is not relevant for today's discussion is because that was changed in the 2019 revisions. And so therefore those changes have already been baked in and they were not affected by the 2020 amendments. The second part of the analysis really goes to the Super 23A part that I talked about, and it's whether the banking entity engages in any covered transactions with the covered fund. And by courtesy of the 2020 amendments, we have some new exemptions so that a banking entity may have an ownership interest under the asset management exemption, may be an investment advisor, et cetera, with a covered fund and still engage in covered transactions such as providing a loan, having a positive derivative transaction exposure, et cetera. The last item that is unchanged is it goes to the systemic risk, or we'll say the hard stop prohibitions of the Volcker Rule. That really is unchanged. Slide. So what were the changes? The first is in the definition of ownership, there were two key changes. The first was a narrower scope in that the definition of ownership interest allows a banking entity acting as a creditor to have certain additional rights that are not triggered exclusively by an event of default or acceleration. And so these might be things like the resignation of an investment manager or other activities involving an investment manager where the creditor might have a temporary right to participate in the replacement. Those were problematic under the original definition of ownership interest, and the 2020 revisions recognize that by permitting these rights outside of an event of default. The second significant change was a safe harbor for certain senior loan and senior debt interests. It is still, well, I'll say narrowly and somewhat subjectively defined as to what is a senior loan or senior debt interest, but for creditors who are pretty high up in the stack, it is a positive that there is this safe harbor that they can work on their counsel to find out if their interest qualifies for the exclusion from the ownership interest definition. The 2020 revisions also eased the eligibility criteria for certain exclusions, and we're going to focus on these, particularly on the loan securitization exclusion, because that's one that we encounter often in our practice, and we think our clients encounter at a significant amount. That the loan securitization exclusion was intended to implement the statutory instruction that the regulators not prohibit traditional securitization activities. And it was, again, more narrowly implemented than maybe we would have liked, but it provides that if you are a banking entity, you can sponsor and invest in securitization vehicles that hold only loans. And loans was narrowly defined, holding loans was narrowly defined to loans, certain servicing assets, hedging instruments like interest rate or foreign exchange derivatives, and some types of SUBIs that, again, we don't see too many of that last bucket, but that was really all a loan securitization vehicle could hold. The 2020 revisions clarified that you could have servicing assets other than securities, which is what we had always thought it was intended, but the language was not clear. It also clarified the meaning of cash equivalents to say that you can hold certain types of, we'll say, like money market instruments or other things that maybe look like a security, have a term to them, but are really treated as a cash equivalent. That was clarified. And the big one is that they added a bond bucket saying that up to 5% of the value of the loan securitization issuer's assets could be held in debt securities. And so this 5% bond bucket is still not as generous as maybe some of the historical 10% bond buckets that were used in loan securitizations, but it does provide some flexibility for issuers or their administrators to shift investments around into debt securities. The 2020 amendments also created 4 new exclusions, and some of these are rather specialized, so we'll touch at them on a high level. But they relate to credit funds, which we like to think of in many ways as like a loan. It's very similar to the loan securitization exclusion, only it does not permit the issuer to issue asset-backed securities. So it's helpful for a vehicle like a warehouse or something else where it has not yet started issuing the ABS, but it still has a huge pool of loans in the vehicle. And also it limits the vehicle from engaging in certain prop trading activities or other types of Volcker activities. But the credit fund exclusion really has some potential there to smooth the life cycle for issuers. The other exclusions relate to venture capital funds, and customer facilitation vehicle and family wealth management vehicles, and are, again, rather specialized and targeted at specific areas of the banking industry. But the one part I will add is that for the customer facilitation vehicle, it's limited to facilitating customers' requests, but much as the name of this program mentions, it is not limited to reverse inquiries, that a banking entity is allowed to advertise that it will enter into customer facilitation arrangements through funds, that it has to be in response to a customer's need. It's limited to providing for a customer's need, but there is flexibility under this exclusion to promote it to customers. As I mentioned, these exclusions are great because they do allow these specialized types of businesses, but given that they are so wide-ranging for things like family wealth management vehicles, they will remain subject to the prop trading prohibition and the Super 23A restriction. So a banking entity couldn't create a credit fund and then use it to engage in prop trading of debt securities, that would still be problematic. Slide. The other parts that I'll move quickly through so I don't steal too much of Jeff's time is the codification of foreign excluded fund relief. And so this touches on our point of you have an issuer who qualifies for an exclusion from the definition of covered fund and therefore is not subject to the covered fund prohibition. But in doing so, they become a subsidiary of the banking entity and become subject to both prop trading and covered fund prohibitions. And this relief will allow such entities to qualify for exemptions from the prohibitions against prop trading and covered fund activities. And so it allows you to have your cake and eat it too, that you are excluded as an issuer from the definition of covered fund, and you are exempt from having to comply with respect to your own activities in the prop trading and covered fund prohibitions. The last one I'll touch on is this incorporation of Section 23A exemptions. That there had always been a question under the Super 23A of the Volcker Rule of whether of exactly how it related to the exemptions provided for under Section 23A of the Federal Reserve Act. And there were concerns about how some of the exemptions in the Federal Reserve Act are linked to very specific facts and circumstances, such as if the covered fund would have been a securities affiliate, and that just is unlikely to have occurred. And so the regulators clarified that first, you can rely on the exemptions in Section 23A of the Federal Reserve Act. And second, they created a new Volcker Rule specific exception to the Super 23A restriction to allow riskless principal transactions with covered funds that are not a securities affiliate. And so this is really useful for a banking entity that's looking to facilitate, say, a hedge or a lending transaction, and it can do so on a riskless principal basis, or even let's say a brokerage transaction where there might be margin involved. All of that would be things that could now be provided on a riskless principal basis. So those, as you can see, there were a lot of nuances changed in the covered fund prohibitions of the Volcker Rule, and those are still being implemented as structures come up for their annual renewals, or as people begin developing their issuers for their 2021 series. And so with that, I'll turn it over to Jeff to get started on the next development. Slide.
Thanks, Matt. And before we do, I just want to take the moment to answer a question that somebody had given while you were talking about the Congressional Review Act, because I think this has come up a couple of times around the Volcker Rule. And we don't believe, given the day count, the Congressional Review Act, just for those of you who aren't familiar with it, basically allows Congress to reverse a rule that's been enacted by one of the agencies. There's a period of time in which they need to do that. And obviously with the White House, the Congress, the House and the Senate being controlled by the Democrats, they could certainly go back and look at some of the rules that were issued by some of the Trump agencies over the past couple of months, past few months, and reverse those. We don't believe that the Volcker Rule is within that window anymore. We were looking at this day count very carefully, and we had been kind of tracking it, but we think it's passed. We also don't think that the Volcker Rule is really something that would necessarily be well suited for the Congressional Review Act, because, as you know, if the rule is reversed under the Congressional Review Act, the regulators are precluded from rulemaking in that area. So it could be particularly problematic with the Volcker Rule to tie their hands like that. So that's just kind of touching on the Congressional Review Act question that somebody had. But if you have questions while we're going through it, just put them into the chat box, and we'll try to address them as we can. Now let me talk about the control rule. Next slide. As I think as everybody or many people know, control for purposes of the Bank Holding Company Act or whole of the Homeowners Loan Act is basically a three-pronged test. First one is if you control 25% or more of any voting class of voting securities, or second part is if you have the ability to elect the majority of the directors. I think the third part of the test is always where the challenge comes. It's the controlling influence. It requires us to consider a facts and circumstances determination. In any company that controls a bank or savings and loan holding company obviously is a bank or savings and loan holding company. So that's why this is important. It's also important, though, for determining whether other entities are controlled by a holding company. And it's not just for banks or for savings and loans. It's for any type of entity. Obviously, being a bank or being a bank holding company has restrictions, consolidated supervision, consolidated capital, activities restrictions, basically not being able to engage in commercial activities. So obviously, if you're investing in banks and you don't want to be a bank holding company, you need to be very careful around these control determinations. Next slide, please. So we talked about the controlling influence prong. I think this is really where a lot of the rule, the Fed's rule comes into play here. I would say this about the Fed's control rule. It basically covers off on what I would describe as 30 years of law and probably 30 years of lore. There's just a lot of guidance that the Fed has provided on a periodic basis, some of which isn't really readily available to the public. And I think it always kind of vexed people, especially those who weren't longtime bank regulatory lawyers, to determine when in fact somebody was controlled by somebody and what some of the factors would be looked at by the Fed. So in January of 2020, the Fed issued a final rule. They had been going through the rulemaking process for the past year and a half. Obviously, it's styled in a way that it's supposed to be user-friendly, it's supposed to be transparent, and it's supposed to codify some of their views to date. The Fed's view is that the rule doesn't really change their longstanding historical perspectives. I think those in the industry can kind of quibble with that a little bit. I think there are some changes that the rule has. The final rule was supposed to be effective last April 1st, but because of COVID, they pushed out that deadline to the end of September 30th, 2020. The Fed has subsequently issued a couple of FAQs or a few FAQs with respect to some of the interpretations of the rule. So even though the rule is a very good attempt to codify the existing law, there are still a number of ambiguities in the rule, and I think there's still going to be circumstances where one is going to have to talk to the Fed about some of the things within the rule, even though that was the goal of having a rule, was to stop those one-off conversations. Next slide, please. The kind of the hallmark of the rule is basically this tiered framework of presumptions of control, based on voting interest percentage, basically. So depending upon what your voting interest percentage is, and a number of other factors will determine whether you control. There are some standalone, presumptions within the rule that are separate from the control presumptions in the tiered framework. There are also presumptions around divestiture of control. This is kind of what we call the tear down rules. So let's just say, for example, you own 26% of a company and then you controlled it. Simply getting down, to under 25% isn't going to necessarily mean you no longer control that company. The tear down rules require you to get down below 15% or get down below 25 and wait a couple of years. That way, people can't just simply divest themselves of, a small percentage and get down outside of control. And again, that's just a recognition of the fact that once you're in control of an entity, you have to do a little bit more than you would have otherwise had to do not to control it. Next slide. Behold the tiered framework. I hold this up as an example potentially of one of the Fed's greatest accomplishments in my 28 years of being a bank regulatory lawyer. This is without a doubt the most practical piece of guidance that's been provided by the Fed, and I think all would agree with that if you've ever dealt with the Fed or read control rules, or looked at any of the interpretive letters that they've issued in this area. This is a very good analysis, a very handy chart. I would encourage everybody who's looking at control issues to have this available. I keep it on my desktop, both on the computer and on my real desk when I get back to the office. And I think it's very important because it walks through. You see at the top, you've got less than 5%. It's really hard to control. When you get between 5 and 9.9%, there are obviously some factors that could lead you to control. And then as you slide down where you have greater control of voting securities, it's more likely that you would control. A couple of things I would point out in the chart that I think we spend a lot of time talking to clients about. Business relationships is the number one. If you have over 5% and you have a substantial business relationship with the company, there's a very good chance that you're going to control that company just based upon the Fed's tiering here. If you're up over 15%, that's all you really have to have is 2% of the revenue of the company and you control. So I think it's very important to keep in mind business relationships when you're structuring relationships so that you don't control. Other things that I think are important in here, there are changes, obviously proxy contests. It used to be that if you were a substantial holder, you could basically not engage in proxy contests. So if you had over 10%, starting a proxy basically would indicate that you were in control of the company. That has changed, and it's a reflection. I think that's not really how the realities of the market works. So I think that's another important aspect. Total equity. Total equity, I think, was always relatively clear, at least what the percentages were. If you own more than 1/3 of the total equity of the company, then you control for purposes of the Bank Holding Company Act. Savings and Loan Holding Company Act control is a little less. It's 25%, and that's just really a difference in the Bank Holding Company Act definition and the Savings and Loan Holding Company definition of control. So that's why there's a difference there. The one thing I would say about the 1/3 of the equity, I think there's a little bit of concern under the rule, and the Fed has tried to address this through their FAQs. When you are investing effectively in a startup company that effectively has negative equity, and you make an investment in that company, it's very easy to see how you could quickly get up over 1/3 of the total equity based upon your investment, based upon their current lack of earnings or lack of revenue. So that's an important aspect to keep in mind. I know, again, the Fed has provided some further guidance on it, but it's something that we've seen a lot of companies struggle with when making investments in startups. The good thing about the total equity determination is it's made one time, and that is when you make your initial investment. It has to be recalculated, obviously, if you make a subsequent investment. But otherwise, if you're static in your investment, you don't have to worry about somehow controlling more than 1/3 of the equity based upon something that's happening within the company itself. Next slide. Talk a bit about standalone presumptions. There are some things that in and of themselves will lead to a controlled determination. The first one of those is a management agreement. And I think basically a management agreement, I think we would all agree, oftentimes will give you control over the day-to-day operations of a company. Therefore, the Fed has historically looked at that as being a presumption of control. What is a management agreement? What's an administrative agreement? I think, those issues tend to come up quite frequently. I think, historically, we have not looked at administrative agreements where somebody is performing administrative functions and they can be hired and fired by somebody to be, in control of the company under a management agreement. Second presumption of control is investment advice and investment funds. Control is presumed if you serve as an investment advisor to a fund and you control more than 5% of any class of the voting securities or 25% of the total equity of the company. So very similar to what you have under control under Reg W, basically, kind of you had historically that advise plus 5 to determine whether somebody's an affiliate. So I think it's a test that we're familiar with. It just is a test right here that's being applied to determine control from a Reg Y perspective and not necessarily just from a Reg W perspective. There are some exclusions for seeding period exclusion. And it's interesting because several people asked about this in the comment process. The Fed is really stepping away from a 1990 letter that permitted retention of up to 25% of voting securities of a mutual fund. That's something that folks had asked for, and the Fed had kind of walked away from that. The third presumption that I want to mention is accounting consolidation. If you control is presumed if you consolidate a company under GAAP. So obviously for a lot of our clients that had asset-backed commercial paper conduits, which were consolidated but historically had not been viewed as being controlled, this changed that dynamic for them. And there are a number of other similar types of companies that historically had not been treated as controlled entities, but were consolidated for accounting purposes. The accounting consolidation, I think, was a very tricky point for the Fed. I think they liked it because it pointed to an objective third-party standard that everybody had to live with, rather than the Fed making independent determinations about whether asset-backed commercial paper conduits and other vehicles were in fact controlled based upon a real, complex analysis of the facts and circumstances. So, for better or worse, I think we're stuck with that for now, in that accounting consolidation point. That's something to keep in mind because you could have really no other indicia of control, but if you're consolidating for accounting purposes, obviously that's control in and of itself. Next slide. This is the divestiture, the basically the tear down provision. I think I talked about this kind of when we were going through it. Again, this is basically the concept that, if you control somebody, in order to get under the control threshold, you have to do certain things other than just getting below 25% and immediately not controlling. So I think that's important. Non-control, I guess, is presumed. This is an important fact for many. If you control less than 10% of every class of voting securities, and there's no other presumption of control. So I think that's an important non-control presumption that's out there. People like presumptions because obviously that gives you some comfort, some ability to rely upon the investment being okay from a control perspective. So next slide. And with that, I will turn it over to Matt, who's going to talk about the net stable funding ratio. And if you had any question about it, Matt is a better person than I, because when he said, "What do you want to talk about?" I said anything but net stable funding ratio. So he's agreed to take on this part of the program. So thank you, Matt.
Thank you, Jeff. And just to touch on one of the questions that came in while you were talking, it was a follow-up actually to the first question, saying some agencies may have submitted notice in certain ways on the Volcker Rule amendments on a late basis. that apparently the CFTC did not report it in the congressional record until November 16th, and of the House for the House report, in the Senate until October 8th. I think we can follow up offline on this question, but the general point I would make is that there can be multiple ways to start the clock running, through things like the Federal Register, through notices provided outside of the congressional record, and so we have not had a concern that one of these the fact that a certain form of it was late would be a problem for the Volcker Rule revisions, because of when it was published in the Federal Register and when it was communicated by letter to Congress. And so we'll follow up with the specific question offline, but that has been our general approach to it. So to turn now to the NSFR requirement, or the net stable funding ratio requirement. This is the second part to a rulemaking that the Fed started in 2014, that after the 2008 financial crisis, there was a concern about liquidity in banks. And so there was a thought that there needed to be two standardized liquidity requirements to ensure uniformity across the largest banks. And the first was the liquidity coverage ratio, which focuses on liquidity over an immediate 30-day window. So how much cash the banking entity will need to send out over the next 30 days. And that requirement was finalized in 2014, and at this point is fairly well understood. The second part to it was also from the Basel Committee on Banking Supervision, and the net stable funding ratio looks more at the liquidity that will be needed over the next year. So again, it's over it's technically over the next year, but we think of it as the 30 to 360 day liquidity range that banking entities need to maintain, or at least to survive intact with their solvency. There have been multiple versions of this proposal in the U.S., and the U.S. regulators adopted a final U.S. version of the NSFR requirement in October 2020. There are some subtle ways that it differs from the BCBS standard, with some things around how it treats flow of funds but among affiliates, other than really insured depository institutions. So mainly thinking around flow of funds from broker-dealers or finance companies, those kind of things. The U.S. version is effective July 1, 2020. And while the ratio requirement, which we'll explain in a minute, is finalized and will go into effect as finalized, there will be corresponding changes to the way in which banks report their liquidity, most notably for some in this room, the FR 2052A, which if you've had the opportunity to work on it, I'm sure you're familiar with the 200-page bullet point guide of how to report the 2052A. For those who aren't familiar with it, you have my congratulations. I would also note that the NSFR requirement, while it is strongly associated with the LCR, it is a separate requirement, and both the NSFR and LCR are separate from the non-standardized liquidity requirements in enhanced prudential standards that Jeff will talk about at the end, that for those who, particularly if it's for foreign banks that have intermediate holding companies, you're probably familiar with the liquidity risk management provisions of EPS, and how a bank has to calculate liquidity over a 30-day period or a 14-day period or 21, again, depending on the type of entity. These are separate from those requirements. Those remain unchanged, and so the qualitative liquidity requirements are still in place. Slide. So who's covered by the NSFR? Well, the NSFR requirement will apply to what are defined as covered companies. Great, super helpful term there. But what that means is it applies to certain institutions who are categorized under the Fed's tailoring rule. So as part of the 2018 Red Reform movement, the Federal Reserve, along with the other regulators, decided that it would be more useful to regulate or supervise larger banking organizations by placing them into categories depending on their size or criticalness to the U.S. economy, so forth. And so category 1, for example, is the 8 U.S. G-SIBs. Category 2 are large or complex U.S. banks or U.S. operations of foreign banks, and so forth down to category 4, which are pretty much big banks, is how I like to think of category 4 institutions. The NSFR requirement will apply fully to Category 1 institutions, Category 2 institutions, and certain Category 3 institutions. And the part of Category 3 institutions who are picked up are those who are not only large, but also have 275 billion or more in weighted short-term wholesale funding. This is a particular focus of U.S. regulators, almost to a divergence from Basel, where it's a holdover from some of the Fed governors immediately after the crisis, who were very concerned with the short-term wholesale funding markets, and so they pushed for an add-on to the various eligibility criteria. Whereas if a bank has a strong need on weighted short-term wholesale funding, then it is pushed into a higher risk bucket. A modified version of the NSFR rule, so at a percentage of say 75 or 65% of the total requirement, will apply to the remainder of the institutions in the Category 3 bucket, and also certain Category 4 institutions. And again, that's large institutions with a significant amount of weighted short-term wholesale funding. Some depository institutions, subsidiaries of covered companies, also will be subject to the NSFR requirement. It's typically insured depository institutions with more than 10 billion in assets who are a subsidiary of the Category 1, Category 2, or certain Category 3 institutions. So typically the IDI subs of the larger covered companies. The NSFR will not apply to foreign banking organizations, which is again same as the LCR scope, and it also will not apply to U.S. branches or agencies of FBOs. As some of you may recall, there was a question during one of the tailoring rulemakings of whether the U.S. regulators should apply standardized liquidity requirements to U.S. branches and agencies of FBOs. Standardized liquidity is a watchword for LCR and NSFR. And the regulators decided that at least at this time, they would not subject the branch and agency networks to this requirement. Next slide. So what is the NSFR requirement? Well, it's called a ratio. Some people call it a coverage amount, and it says that a covered company will need to maintain an amount of available stable funding that is not less than the amount of its required stable funding needs on an ongoing basis. And so for those of us who are quantitatively inclined, we say it's a ratio of 1, saying that you have at least a corresponding amount of stable funding for your required stable funding needs. You have to think of it as 100% of your stable funding needs, or just a dollar value of whatever your required stable funding dollar value is, that you have a sufficient amount of available stable funding. As I mentioned, for the smaller covered companies, they will need to cover only 70 or 85% of their required stable funding amount with available stable funding. And so that's recognizing that given their decreased criticality to the system, that they don't need to maintain a ratio of 1. It is calculated on a consolidated basis. So for primarily the covered companies, that they calculate it at the top tier holding company level. It's a little different in that respect than some of the capital requirements where you might calculate it at intermediate levels of holding companies. But here we're looking at the top tier holding company, and it does account for transfer restrictions, or things like if you can flow available stable funding from an IDI subsidiary, that is taken into account. Covered companies must disclose information on its net stable funding ratio and some of the components of the available stable funding and required stable funding factors in a standardized format. This is again consistent with the LCR disclosures and many of the other disclosures we've seen post-2008 financial crisis related to capital, related to stress testing, and also related to, say, the FRY 15 of the criticality factors for the US GSIB calculations. Subsequent quarterly disclosures must be made twice a year, and that sounds counterintuitive because I said quarterly and then I said twice a year. And what that refers to is the fact that the NSFR disclosure for the first and second quarter may be made after the second quarter. And so then the disclosure for the third and fourth quarter can be made after the fourth quarter. So it still is 4 sets of numbers, but they only have to be disclosed twice a year. Slide. So the RSF amount is based on the liquidity characteristics of a covered company's assets, derivative exposures, and commitments. And it's calculated similar to the risk-based capital ratios in that there's a base amount or the value of the asset, the undrawn commitment, et cetera, that is then multiplied by an assigned RSF factor. An RSF factor of 0 means that the asset or derivative has no need to be supported by stable funding. And that would generally reflect an asset that has a very strong liquidity characteristic, or that is viewed as unlikely to be called upon over that year period. In contrast, an asset that has 100% RSF factor must be fully supported by available stable funding. So this might be something where it's immediately callable by the customer, or it is a demand type instrument where there's a great risk that if there was a type of instability, there would be an immediate need for the bank to put up money to pay off the required stable funding amount. And all of these factors, these RSF factors, are assigned in the final rule based on the credit quality, the tenor, the type of the counterparty, market characteristics, and the presence of an encumbrance on the asset. And so things like retail exposures typically are viewed as more stable than commercial exposures because just of the level of monitoring that a commercial counterparty might do, or things with a very long-term tenor are typically viewed as more stable than demand or open or short-term assets. But that is how the RSF calculation works. Slide. The other type of, obviously, the next thing we would turn to is how to calculate available stable funding amounts. And that's based on the stability characteristics of the liabilities or regulatory capital elements that would be used to support an asset. And so available stable funding is calculated by multiplying the amount of the liability or the regulatory capital element by an assigned stable funding factor. And so the most stable funding sources receive 100% factor. So this is saying that 100% of the liability will be available to pay to support the asset. Or in contrast, a 0% factor is assigned for the lowest stability source of funding. So if there's a thought that it would be difficult to rely on this as a source of funding, that will receive a 0% available stable funding factor, and so it really won't contribute to covering the RSF. And as with the RSF factors, ASF factors are assigned based on funding tenor, funding type, and counterparty type. Notably, ASF factors are not directly linked to RSF factors. That while there are obviously some similarities, if you have, say, encumbered assets, if you have secured assets, there may be questions about how certain types of deposits or short-term investments would work. But the U.S. regulators said they did not want to introduce complexity by providing that linkage. And they also went to pains to say that neither one is directly linked to the LCR requirements. So just because a particular type of instrument might have a 95% ratio, a payout assumption under the LCR doesn't mean it has a 95% stability assumption under the NSFR, that there will be some incongruities across the two regimes. Slide. Derivatives transactions, as many probably on this call are familiar with, are a tricky area because their value is not as readily defined as an asset or a liability because of the nature in which they're calculated based off of a reference pool. And so the NSFR rule adopts the approach from the LCR rule of looking at the current value of a company's derivatives, and then it adjusts that for initial margin provided by a covered company to, say, mutualized loss sharing arrangements or part of the clearing transactions. It also adjusts the current value for potential future changes in the value of the covered company's derivatives portfolio. And so there is a formula for calculating potential future changes in the NSFR rule. If a covered company's total derivative assets exceed derivatives liabilities, then it's assumed that they will need 100% RSF factors to support them, that all of those derivatives will need to be supported by by funding, by available stable funding. If in contrast, there's a total derivatives liabilities exceed total derivative assets, so from the company's perspective, a positive liquidity situation, then the net amount is not considered available stable funding. And this represents some concerns the regulators had about how easy it would be to monetize or deploy funding from this type of net derivatives position. And so really the derivatives transactions will be of most interest to those who are active in this area or have significant derivatives portfolios, but the basic formula is going to be similar to the LCR. Slide. And so just before I turn it back over to Jeff, as we mentioned, the NSFR is being implemented, will become effective later this year. And there are questions about how certain types of assets are bucketed into different factors, either ASF or RSF factors, or how some of the maturity tenors interact, because there are different maturity factors or tenors under each of the factors for different types of assets. And so those are areas that we've been working on with clients to understand how tenors translate from the LCR world, or if it was more than 30-day tenors, how they will apply in the NSFR world. And I think that's maybe one of the most interesting areas is how the different buckets of tenors really affect the stability profile over the 365-day period. But before I steal all this time, I'll turn things over to Jeff to take us home.
Thanks, Matt. And you took the NSFR, so you can have all the time you need, and you can even have all of my share of the royalties from today's program if you want. Let me wrap up today by talking about the enhanced prudential standards. Just wrap that up a little bit. Obviously, Dodd-Frank imposed heightened standards on what we generally thought of were some of the larger and some of the more systemically important institutions that were out there. The original framework was adopted in February of 2014, became effective in 2015, 2016. One of the key things there, obviously, is it required intermediate holding companies for some of the foreign banking operations or foreign banking organizations. Also subsequently imposed the TLAC and other requirements and the clean holding company and single credit counterparty limits. So, I mean, there's obviously significant stuff within the EPS that's there. EPS was imposed on savings and loan holding companies in 2019. So it's not just for bank holding companies. Next slide. One thing that has happened over the years is it's been tailored. There's been tailoring around this. The Economic Growth, Regulatory Relief, and Consumer Protection Act basically amended 165 to basically scope out what were deemed to be not significant institutions. So in other words, it raised the threshold from 50 billion in total consolidated assets to 250 billion. I don't think really many people thought that $50 billion institutions were potentially systemically significant, but that was the threshold set in the legislation, and obviously the regulators really were bound by that. So the Relief Act basically provided some sanity check on that. It also basically increased the threshold for applying the resolution planning requirements. Another one of those standards that kind of went amok. You had 130 banks who were filing resolution plans, and I think 90 of those were foreign branches and agencies in the U.S. So really, there was just some tailoring that was needed, and I think that's an important aspect. There still are some requirements, obviously, between 100 and 250 billion in consolidated assets, or at least the Fed has the option of implying those as well. Next slide. Obviously, the tailoring was done through a series of rulemakings after the Relief Act was passed in 2019 and 2020. Simultaneously, the Fed is also applying these requirements to the capital planning, stress testing requirements on its own initiative. Those partially overlap with EPS, but not totally. So they're separate and distinct. Some of them have been joint rulemakings with the OCC and the FDIC, obviously with respect to stress testing. And obviously the resolution planning rules are obviously joint rules as well with the FDIC and the Fed. Next slide. The The tailoring also takes the category approach, and Matt talked a little bit about this in the NSFR section, but basically it breaks it down to 4 categories. Category 1 being the G-SIBs, category 2 being basically the other extremely large banks, 700 billion or more in assets, and then just kind of tiers it down. So you get to category 4, which is 100 billion to 200 billion in assets. There's further tailoring within these categories based upon the size of the operation. So that's just something to keep in mind. But the tailoring was really designed to bring some rationality to the regulatory regime that we impose on institutions, recognizing obviously that not every institution presents any sort of significant threat to the U.S. financial stability. Next slide. I think this is a good kind of slide just to kind of keep in mind what the requirements are on the different categories of institutions. I'm not going to read from it, but I think you'll see obviously that the category 1 institutions, the G-SIBs, have much more robust and many more requirements that are applicable to them. And as you walk down the categories, they obviously become less and less, recognizing the fact that smaller institutions, present smaller challenge, smaller risk, and therefore they don't need to have the same requirements on them. So I think this is obviously, again, a good demonstration of the rationality of the current tailoring regime that we've imposed on people. Next slide. Just some other developments, I guess, going on. There's continued tailoring that's kind of going on around these requirements. There's an integration of the categories approach that Matt was talking about in the NSFR. Category approaches for capital planning and stress capital buffers. Looking at the Fed, because the supervisory letters here identified. There's also a modification of advanced approaches capital requirements to deduct certain investments in unsecured debt securities. Flows through to TLAC and to the long-term debt requirements as well. There's also an integration of categories approach in the setting of supervisory assessments. So all of this, again, is further tailoring on the enhanced prudential standards that originally came out of Dodd-Frank. There's going to be further tailoring, further tinkering by the Fed, obviously, with respect to stress testing, capital planning down the road, just again, to bring more rationality to those. And I think with that, that's our last slide. And I think we're just about to hit 2 o'clock. So thanks, everybody.